Hey everyone, welcome back to the Market Stalkers channel. Let's talk about the misconceptions of the value area usage. If you're not familiar with the value area, it's a fancy way of saying the distribution curve, the belly curve, from yesterday's trading activities. There are some common mistakes that I see in my line of work as an educator, but also as a professional prop trader. I'm still currently funded with several prop firms, and I use the market profile and the value area every single day. I've done that for the last 10 years. So before I went into professional prop trading, I've traded for 5 years just for myself. Okay, so that doesn't include the 10 years that I mentioned. And after those initial 5 years, I then decided that I might be good enough to make this into a actual trading career. So I may know a few things about how to properly use the value area. So let's dive into this. The first misconception. Loads of people, when they first come across the value area, they think that they need to use the current developing value. Now, the current day's developing value, it does have some value, but mainly in reading the strength of the current move. However, that's not the primary use of the value area. Certainly not where its strengths lie. So let me say it here. If you're trying to use the value area to determine the highest probability direction that the price will take on that day, aka to read the open sentiment, you need to use the previous day's value area. The value area that is finished, done and dusted. Why? Because you want to see where today's session is opening in relation to the distribution curve from yesterday. And what is this distribution curve from yesterday? Well, it's where the majority of the business took place. In other words, where the price spent the most amount of time. And how can you do that if you're staring at the developing value, which is still subject to change,
with every single tick?
You can't. It's like trying to read the daily candlestick pattern halfway through the daily candle before the entire 24 hours of trading is over. So that is the first mistake that novice order float traders commit, attempting to use today's developing value. The second misconception is that you can use the entire 24 hours of yesterday trading. Again, this might have some use as a directional indicator to see whether the value areas, aka the distribution curves, are overlapping, or whether maybe they have some distance between them, which can indicate a trend or a breakaway from the range. But for intraday open sentiment, you need to only use the active hours of the session that you're trying to trade. So whether that's London session, Asia session, COMEX, NYMEX, New York Stock Exchange, Tokyo Exchange, all of them have what's known as the regular trading hours, aka the RTH. So that's what you need to determine where your value area starts and where your calculation for the value area will end. That is what determines where yesterday's business took place, because different players are involved for every different session. The final misconception is that the value area from yesterday can also be used as some kind of a weird support resistance when the market opens inside of it today. And that is not how the value area is used. So we're talking about a day that might be a little bit rangy. In that case, you might be able to use the current day's TPO profile, the extremes of the profile, as turning points. But we're talking in a very specific case where this could be done. And yet still attempting to use the value high and value low from the inside of value, that's a sure way to lose lots of trades. However, the value area edges from the outside of value, especially if the move that came before it was quite prolonged and pronounced. So you had, a few hours of trending and then you come across yesterday's value. That's actually a really good high probability trading location. So with all of these misconceptions and misuses floating around, is it any wonder that a lot of people still think that market profile is
something that used to be done in the 80s, but it doesn't really work anymore?
It does work. It is life-changing stuff, but you have to use it properly. You have to use it as it was intended to be used. And if you're someone who has done this and misused value in one or even more ways than I described in this video, I would highly advise that you try going through my market profile course on Udemy on Skillshare, where I explain all of this in much more detail. Now, if you want to dive in right into the entirety of the Market Stalkers method that uses not only market profile, but also order blocks on large time frames, statistical averages, using any single unique strategy is not the path to profitability, okay? I've said this before that most of us successful traders, we are kind of a mishmash of the strategies that we've used over the years, and we've kind of stuck with the things that worked and threw away the things that don't work. But there are some commonalities with everybody who is a professional. We all use some sort of order flow. And to give you some kind of a shortcut, that's why my Market Stalkers method exists, because I show you what worked for me. So if you want to dive into that and to start learning properly from the backbone of the method, which is order blocks on supply and demand, and then all the way through the market profile value area, statistical average is used in many ways to determine volatility or lack thereof, then you may want to check out this link here, because that's where you're going to find all the details about it. And the whole point of the method is to give you a deep understanding of the day's narrative. Now, if you're a supply and demand trader, aka you're using order blocks to trade, and you're struggling to use it for intraday trading, then you really need to watch this video here.